Here's a silly question. Why is the standard mortgage a fixed rate loan for 30 years? And when I say standard, I mean here in the United States, because not only is this not the norm around the world, it wasn't even always the norm here. So to understand how we got here, we're going to take a curious look at the history of the mortgage, because few things reveal how money and finance evolve like the magnificently mundane mortgage. Our friends Alex and Jordan are house hunting. They're excited, nervous, and totally overwhelmed by mortgage terms. Like, why does every lender keep offering a 30-year fixed? Where did that even come from? Before we get ahead of ourselves, let's define two terms. Amortization is the full life of a loan, or how long it takes to pay it off in full. The term, or fixed rate period, refers to how long before that loan must be refinanced, paid off, or have the interest rate reset. Let's now go way back in time. By the 5th century BC, Persia had mortgage-like lending systems. The word mortgage comes from medieval England. It started as a Latin term, and spoken in French, it was pronounced mort gage, meaning dead pledge, and referred to a loan that ended when either the debt was paid or the property was taken. By the 18th and 19th centuries, England and parts of Europe had active land loan markets. Some involved cooperatives, where members pooled funds to finance each other's homes. In early America, things were tough. Mortgages started off with terms of 5 to 10 years. Down payments were often 40 to 50%. And when that short term ended, borrowers had to refinance or pay the whole thing off. That was fine during boom times, but a disaster in downturns. Cue the Great Depression. In 1933, nearly half of U.S. mortgages were in default. Homeownership was declining, foreclosures were rising, and banks were failing. The U.S. government now enters the chat. The Homeowners Loan Corporation, HOLC, was created in 1933. It bought troubled loans and refinanced them with longer, fully amortizing terms. A year later, the Federal Housing Administration, FHA, was created and transformed housing finance. It lowered down payments and extended loan terms, opening the door to homeownership for millions. Then in 1938, Fannie Mae was formed, and it created the first secondary mortgage market, buying mortgage loans from banks so they could issue more mortgages. Taken together, between 1934 and 1972, U.S. homeownership rose from 44% to 63%. Our friends Alex and Jordan's grandparents probably benefited from that boom. But how did we get from 5-year mortgages to 30-year mortgages? Like we've seen before, changes came after a war. In this case, 1944, with the passage of the GI Bill. Millions of returning war heroes received access to 20-year fixed-rate mortgages with capped interest rates, often around 4%. Those terms worked so well that non-veterans lobbied to get those terms too, and eventually they did. The 30-year mortgage didn't win out because it was economically optimal. It won because it was politically popular and institutionally supported. Let's shift over to the lender's perspective. To them, a 30-year fixed-rate mortgage is risky, especially if interest rates rise. So why offer them? It's because the government helps absorb that risk. With deposit insurance and Fed backstops that protect lenders, the FHA, VA, and GSE guarantees, which protect investors, and the political reality that Americans have come to expect long-term fixed-rate financing. So Alex and Jordan, they don't even question why the 30-year fixed is standard. They just assume it's always been that way. But it wasn't. It was built layer by layer through policy and culture. But if 30-year mortgages are good, why stop there? Especially when some countries, like Japan and Sweden, offer 40 or even 50-year mortgages. After all, longer amortization lowers monthly payments, meaning people can buy more house with the same income. But that extra purchasing power increases demand, which often leads to higher home prices. That's great if you own a home, but not so great if you're Alex and Jordan, still trying to buy your first one. Which brings us to affordability. Everyone agrees housing should be affordable, but proposed solutions often make it worse. For example, increasing mortgage subsidies or extending loan terms sounds good, but if supply doesn't increase, prices rise even faster than they otherwise would. Building more housing would help, but when a new housing development is proposed in your backyard, it gets complicated quick. Let's take a quick detour to discuss securitization. Mortgages today are rarely held by the bank that issued them. Instead, they're bundled into mortgage-backed securities and sold to pension funds, insurance companies, commercial banks, and even the Federal Reserve and foreign central banks. This system helps spread risk, but also played a big role in the 2008 financial crisis. More on that in future videos. Of course, we can't talk mortgages without talking interest rates and how they are set. They usually start with the 10-year U.S. Treasury bond, the rate a lender could earn by lending to the government. But mortgages carry credit risk, meaning you might not pay, and prepayment risk, meaning you might pay early. So lenders add a premium, typically 1.5 to 2 percentage points above the 10-year Treasury when they price mortgages. Pull up a chart of the 10-year Treasury and see for yourself. You're curious after all, aren't you? With all this talk about 30-year mortgages, you may be curious how long the average mortgage lasts. The answer is just 5 to 7 years. That's right. Alex and Jordan might get a 30-year mortgage and only use it for 6. You made it to the end of a video about mortgages of all things, so we know you're a curious one. If you learned something today, or even if you're just here to support Alex and Jordan, hit like and subscribe and drop us a comment on what money topic you're still curious about. We'll see you next time, and stay curious about money.